Hello, everybody, and welcome to this fourth lesson on the Trade Life Cycle series. I've already uploaded videos on the equities portion, on the fixed income securities, as well as understanding the market ecosystem. Over here, we're going to look at the market participants, the who's who of the markets. The previous video, the third lesson, took a understanding of the fixed income securities, where we explained in great detail about bonds, the different types of bonds, concepts of accrued interest, etc. And in this chapter, we're going to take a look at who are the different market participants, what is the role of the participants, and understanding how their activities start and the continuation of the series when they're doing a settlement cycle, corporate actions as well. So let's take a look at some of the market participants. If you're working in an investment bank or you're processing securities traded across the different stock exchanges, these are some of the terms that you come across. These include stock exchanges, also called as share markets, share bazaar, etc. You'll understand the concept of a transfer agent. In some markets, transfer agents are called as registrars. What is the role that they play in the whole trade life cycle? What is a custodian? Why is a custodian important? There are also terms like depository, understanding the role of the central securities depository, that's the CSD, and of course, terms like the prime broker and the non-prime broker. So what are all these entities? Who are they? Are they individuals? Are they corporate entities? How do they work? How do they operate? Because many times people get confused even with concepts like stock exchange and share market. What's the difference? Yeah, so then let's try and understand a little bit more of all of these. A stock exchange is a regulated centralized trading platform. I've already uploaded multiple videos on understanding the concept of a stock exchange. What do we mean by regulated? It is regulated by the members of the stock exchange itself, as well as regulated by the Central Capital Market Regulator, like the SEC in the United States or SEBI in India. The stock exchange now are trading platforms, okay, which match buy orders with sell orders with buy orders, depending upon the price, depending upon the volume. There are so many types of orders that get filtered into the system. And what are the kind of orders that are put in? How are they processed? How are they executed? How are they matched? How does a quote become a price? How does an order become a trade? All this will be discussed in the upcoming videos on understanding the different types of orders. On a stock exchange, there's a very important process called as listing. Okay? So unless it's listed, instruments cannot be traded. And therefore, instruments like stock, futures, options, etc. are instruments that are clearly defined and listed on the stock exchange. So over here, the term SE, I've used an acronym called SE that stands for stock exchange. The stock exchanges are regulated, centralized trading platforms. I've now abbreviated the stock exchange to StockX, and I'm continuing with the discussion on how the stock exchanges operate nowadays, like the Tokyo Stock Exchange, National Stock Exchange, and New York Stock Exchange. They own the trading technology. The trading technology defines the speed with which orders are executed. It defines the skill of arbitrageurs and leveragers in executing complex trades on the markets. So stock exchanges are continuously refining this trading technology, which is then proprietary, licensed to different brokers. So the stock exchanges appoint brokers. The brokers are dedicated to specific stock exchanges and they are called as members of the stock exchange. Moving on to the second entity, brokers. The brokers are registered members of the stock exchange. So the next question is, can I become a broker? Sure, provided you meet the requirements of net worth qualifications and or licensing fees that you've got to pay for the technology every year. Let's take a look at some of the examples of the fees that are charged for Indian brokers. Like you've got to have a net worth of 5 crore rupees. Okay, that's close to $500,000. In the United States, that would be almost $5 million. Okay. And in annual licensing fee could depend upon how much trades are getting executed through your platform, what are the kind of fees you can afford for market data. All these are fees that are paid by brokers. And what do the brokers get in return? The brokers get extremely hefty brokerage from executed trades. Therefore, brokers don't mind paying these kind of fees to the stock exchange for the proprietary trading software for the execution capability simply because they are able to execute large value orders, and these large value orders result into a hefty high brokerage commission for the brokers. Brokers thus are licensed to operate on specific markets. In the good old days of physical trading, we used to have brokers who would actually meet on the floor of the trading stock exchanges, called as jobbers. But now we are all electronic in nature. We just meet on Friday evenings or Thursday evenings for parties and stuff like that, or meet clients so that we get bigger value orders. A broker is a very key entity in a stock exchange because they also participate in the regulation of the stock exchange. Okay, while brokers are competitors, they are also collaborators of the stock exchange. So the stock exchange, while it's just a trading platform, the brokers have to ensure that all trading is done through the brokers. If trading is not done through the brokers, okay, and it is done off market, like for example, if I want to give some shares to my daughter and I decide to transfer it into her name, the deal need not be routed through the stock exchange. I can directly transfer the stocks to her name, and that is called as an off-market trade. In an off-market trade, there is no matching of orders, there is no concept of a buy order, sell order, trading, pricing, etc. simply because all of the orders are then executed on the stock exchange. So off-market trades are those that are not executed on the stock exchange. Market trades are those that are executed on the stock exchange. Typically, less than 0.5% of orders are off-market trades, okay? Because the brokers and the stock exchange collectively have to ensure that all of them are consolidated at a single place. A stock exchange, let's take a look at this to simplify the whole, relationship between a stock exchange and a broker. A broker is a member of a stock exchange. There could be another broker that's a member of the same stock exchange. Multiple brokers can be brokers of multiple stock exchanges. A single broker can be a broker of multiple stock exchanges, etc. So, but they have to have the licensing fee which allows them to operate. So what is the role of the customer over here? If the broker has to execute the orders, what is the role of the customer, like you and me? If we want to trade or we are retail investors, what about the larger institutional investors like hedge funds, mutual funds, etc.? They are also called as clients of the broker. So a broker can have multiple clients who place in the orders, and the clients are aligned with the broker. The broker is a member of the stock exchange. Okay, so the client-broker relationship is different from the broker-stock exchange relationship, and therefore in a stock exchange we always say that there is very little counterparty risk because all brokers are members of the stock exchange, and the counterparty for all trades therefore is the stock exchange. We then come to a new term over here called as prime brokers. A prime broker is a broker who only deals with high institutional clients such as hedge funds, where the value of each trade runs into millions of dollars. This is because hedge funds, mutual funds, pension funds are extremely savvy clients, and when they trade in the markets, the volumes that they trade in could move and shake the market. If a large buy order is placed, for example, the market's prices could go stratospherically high. If a large sell order is placed, then the markets could collapse. To prevent all of this, institutional clients rather deal with prime brokers, brokers like prime brokerage services of, let's say, Goldman Sachs, JP Morgan, amongst others, who bring together a good execution capability of meeting with the client's requirements. So therefore, prime brokers are brokers who deal with institutional clients, and they give them the entire range of services. Look, institutional clients are giving minimum volume sizes of $1 million plus. So therefore, they need very, very savvy services, very skilled services, very swift responses. And all of this make prime broking a very sophisticated investment banking activity. Moving on to the third entity is a depository. Over here in this video, we're going to discuss about the Central Securities Depository, or the CSD. A depository means a holder of things, okay, in English. Securities are held in an electronic form with the depository, or the CSD. The CSD keeps the ownership records. So for the entire securities, all the securities that are listed on the National Stock Exchange, They are held in an electronic form with NSDL, right? And they keep the ownership records of how many shares or how many debentures, how many bonds are held by which kind of investor. The depository facilitates transfer of ownership from the seller to the buyer, and therefore the depository services are, literally God given, because many times it's very difficult to go through the physical method of transferring of shares, and therefore let's see how this is done. Have you heard of the words DTC or JASDEC or even CDSL? I'm sorry, or even CDSL. Yes, these are depositories of different countries. Okay, so for example, GTC is of the United States, JASDEC is of the Tokyo Stock Exchange, Osaka Stock Exchange as well. CDSL is of course of Bombay Stock Exchange. So different countries have their own CSDs or their own central securities depositories. What is the role of a depository? The role of a depository comes at two different stages: during an IPO and post-trade activities. Let's take a look at what is the role of the depository in the case of an IPO. An IPO is an initial public offering when the company has issued shares to the general public for the very first time. So when they issue shares, every share has to be numerically numbered. Okay, so it works on a numerical system of numbering every share. So now if you look at 6,500 crores worth of shares are being issued, then each of those 6,500 crores of shares have to be numerically numbered in terms of a numeric arrangement system. So during an IPO, the depository immobilizes the stock. Immobilization is also called as dematerialization. That means making a stock available in a digital form. This is the most important role of the depository because this enables short sellers and also prevents short sellers from getting away without squaring off. Okay, so this prevents the market collapsing below the short selling kind of levels. On listing of the company's stock, digital stock is then released onto the exchange. So you might be thinking of a company's, and I actually got this question, a company, let's say, has 10,000 shares issued at the time of an IPO, okay? And is it that 5,000 shares are listed on NSE and 5,000 are listed on BSE? No, it doesn't matter at all. All the 10,000 are listed because these are all free floating stock and these are not locked in stock, and therefore on listing the digital stock is released to the shareholders and to the investors. As a part of the post-trade activities, the depository also records the quantity and ownership detail. So there are two levels of activities for the depository. The first one is during an IPO. Second one is as a part of the post-trade activities. As a part of post-trade activities, it must record the quantity of the trade and the ownership details that have to be changed. Most stock exchange, how will it get this information? It will get this information from the stock exchange. So we saw, like for example, CDSL will get the information from Bombay Stock Exchange. JASDEC, which is the Central Securities Depository of Japan, will get its details from the Tokyo Stock Exchange. If the trade has been executed on the Tokyo Stock Exchange, the JASDEC within that T+1, that is the rolling settlement trade day +1 and or rolling settlement T+2, must record the trade and also get a clearance from the transfer agent to be able to transfer the ownership from the seller to the buyer. All this happens within this rolling settlement of T+1 or T+2. The fourth entity we're going to look at is the transfer agent, also called as a registrar in many markets. This registrar is an entity which facilitates settlements of trades as well as corporate actions. The transfer agent over here records the transfer of ownership of shares or bonds or debentures or any other kind of security from the seller to the buyer. This is the most important job of the transfer agent. If the transfer agent is not comfortable, okay, with the trade that has taken place on the stock exchange, then the transfer agent can create an objection for that and stall the settlement of the trade. So all responsibility of settlement of trades take place by the transfer agent. In an IPO, the transfer agent allocates the shares per investor. So during the IPO, you know that, excuse me, the company keeps the IPO open for 3 days or 5 days, and all shares, interested investors subscribe to the shares, they apply for the shares. Sometimes the issue is oversubscribed, sometimes it's undersubscribed. The transfer agent allocates the shares per investor. After allocating the shares, they must inform the depository that the demat account of which investor has been credited with what quantity of shares. Okay, that's how we get the credit into your demat, demat accounts, or into your shareholding accounts. Moving on, as a part of the post-trade activities, the transfer agent verifies and approves the transfer of ownership. So look, in the securities issued, or in equities issued by a company, there could be restricted equities, there could be equities held by the promoters, which is not a part of the free floating equities, etc. So who creates clarity on these kind of issues and approves the transfer of ownership from the seller to the buyer? Yes, my friends, it is the transfer agent who does this, and therefore the transfer agent's role is extremely important as a part of the post-trade activities. The transfer agent then gives the confirmation of the decline to the depository and says yes or no, whether the ownership can be transferred from the seller to the buyer. The transfer agent is extremely important in all corporate actions. Corporate actions are actions like announcement of dividends, bonuses, redemption of bonds, etc., wherein the issuer influences activity on the cash flows or non-cash flows of the security. The transfer agent calculates what are the entitlements per investor, informs the custodian that this is the entitlement of the investor. So what's the difference between a transfer agent and a depository? Let's take a look at that. A transfer agent is appointed by the company, okay, the issuer of the securities. The depository is appointed by the stock exchange. So while we think that most of the activities of the transfer agent and depository are more or less the same, in reality, they are different because they are viewing it from different angles or from different points of view, because the transfer agent actually is protecting the interest of the company. The depository's job is to ensure that all settlements take place within that T+1 or T+2 cycle. So the angle with which they're looking, the point of views are completely different. The second one, transfer agent is responsible for all corporate actions, so is the depository, because they have to keep all the updated details of the stock exchange securities. The transfer agent transfers ownership from the seller to the buyer. The depository records the change of ownership. Without transfer agent's approval of the trade, the transfer cannot take place, and depository has all rights to cancel the trade if there's any fraud or any kind of inclination that has taken place in the trade that has happened on the stock exchange. The fifth entity is a custodian. So who is the custodian? The custodian is appointed by the asset manager. As an asset manager, why do you appoint a custodian? The custodian is responsible for managing and holding all the shares or bonds of that particular asset manager. Look, asset managers like hedge funds, mutual funds are extremely large entities. They own trillion-dollar investments, right? This could be in commercial paper, this could be in certificates of deposit, it could be in treasury bills, it could be in bonds, it could be in 30-year bonds, it could be in preference shares, whatever. The asset manager allocates each of this to the different custodians. Custodians are responsible for managing the securities. So what is the managing of the securities? Let's take a look at some of the roles of the custodian. In an IPO, the custodian is informed by the transfer agent. TA means transfer agent, about client allocations. Very important. If the custodian doesn't know, then the custodian will have to check whether the credit or the shares has come into the demat statement or the credit of the money refund has come into the bank statement. The custodian is therefore, after receiving this credit into the account, they must inform their client. So who is the client for the custodian? The AMC, or the asset management company. And the asset management company could be a pension fund, a hedge fund, a mutual fund, whatever. But custodian is responsible for all actions initiated by the asset management company. As a part of the post-trade activities, the AMC, Asset Management Company, sends the settlement instructions to the custodian. These are the SSIs, or the settlement instructions via SWIFT codes to the custodian. The custodian has to execute and act on those settlement instructions to facilitate the sale of the shares. If it's a sell trade, to debit the AMC's holdings. If it's a buy trade, then to debit the bank account, etc. So there's a lot of post-trade activity that the custodian does. And the custodian also does a lot of corporate actions. They calculate the entitlements, and more importantly, they calculate the X dates, because the custodian is acting on behalf of whom? On behalf of the largest trading community in the world, that is the asset manager. So large holdings would be released or would be kept in the stock exchange. For these purposes, the custodian has to ensure that what is the record date, what is the X date, when will the entitlement come into the credit of the client, that is the asset management company, and how does the custodian then inform the AMC about the corporate actions that have been received. Okay, so all these things are very, very important. Like your Northern Trust, which is the largest custodian in the world, and they have to inform their clients who hold $1 billion worth of assets in their individual holding on the corporate actions receipt. So what's going to be the next lesson? The next lesson is going to be on what are the pre-trade activities that take place. So we've now understood the different types of equities, the different types of market participants. We have also understood the different type of fixed income securities. We'll now take a look in the next 5th lesson on what are the pre-trade activities. Thank you so much.